Hi, you're listening to the Wall Street Oasis Podcast, a podcast about breaking into the world of finance, along with interviews with those who have. I'm Alex Grodnick, your host, and today we are speaking with Rohit Kaur. Rohit and I became friends when we both worked at Houlihan Lokey, even though I was in LA and he was in London and then New York. Rohit now lives in Hong Kong and works at a hedge fund. He's in LA for just a couple of days and is staying at my house. Rohit did not want to do this, but I told him it was either this or he gets a hotel room. So here we go. Rohit, hi. So, wouldn't it be cool if there was a Netflix for finance? Well, there is. It's called Real Vision, and it gives you unprecedented access to some of the most respected names in finance. Watch interviews with legends like Kyle Bass, Jeff Gundlach, Stanley Druckenmiller, and many, many more. If you want to be part of the Real Vision revolution, visit realvision.com/WSO. Tell us what you've done.
Yeah, so we met while we were at Houlihan in New York. I went back to London. I finished off the analyst program at Houlihan, so that was about 2 years. The first year and a half in London, and then I transferred internally to our New York office. The impetus around moving back to New York was kind of twofold. First, I wanted to be on the principal side, and recruiting for opportunities in London. I mean, this is before Brexit, and interestingly enough, it's actually like harder for people. It was actually harder for expats or American expats to find opportunities in London for a few reasons. First, a lot of funds would require you to get sponsored, right? So especially like kind of smaller funds, but for the larger funds that even if they got past that hurdle of like giving you a visa, London's super cosmopolitan. The distressed market in London is very specific to certain geographies, right? So, back in 2013, 2014, when the Spanish real estate market was kind of in the doldrums, people were looking for, analysts with Spanish language skill sets. Or similarly, I mean, during the European financial crisis, like from 2012 through 2015, let's say, basically every European periphery, as well as a lot of like developed European markets like France and Germany had interesting distressed investment opportunities, but to be able to kind of look at those deals, you need to speak either French, German, or Spanish, and whatever language was in vogue at the time for a particular restructuring, scenario. That would have been like super helpful. So the big challenge is like having that second language skill set, which I think a lot of, at least, I mean, I speak Bengali, which is not very helpful. I know a little bit of French, and a little bit of Spanish, but it's not like, business fluent. So those were the two like challenges I had in terms of interviewing and finding opportunities in London. And so that was one big impetus for me to move back to New York. And like the market for opportunities on the principal side in the US, especially New York, are a lot greater. And the second thing is like my twin brother was in New York, and, I had a lot of friends in New York. So just family and friends, and also like being outside the US for 3 years, like, you miss that a lot.
Yeah, you're from Ohio.
Grew up in Ohio. Well, I was born in India. Grew up in Ohio. Went to college at Cornell. So I double majored in math and economics at the time. While I was at Cornell, I had 2 summer internships at JP Morgan.
And like they're just regular investment banking?
So my first internship was actually, my offer was from Bear Stearns and their FAST program. So that stood for Financial Analytics, Structuring, and Transactions. The FAST program was essentially like a gateway into sales, trading, or structuring. And this was like a prestigious program within the Bear Stearns internship, right? So MBS trading was what Bear was known for. And if you did well, you could, I mean, it was a model which was very like kind of old Wall Street and like encompassing like greed at the time, right? So if you did well, you would essentially eat what you kill. And there were, people that were millionaires by early 20s, mid 20s.
Wow.
Like Ace Greenberg had a philosophy. He was like, I don't want an Ivy League degree. I want a PSD degree.
Right. Poor smart driven.
Yeah.
I read that book about counting paper clips.
Yeah. So, and the culture at Bear was like very different than a lot of the other investment banks. So anyways, yeah, I was fortunate enough to have an offer in the FAST internship program.
So you thought, okay,
so I thought,
I'm going to be a millionaire in a couple of years.
Well, I mean, I think outside of that, I like the idea of, you had the opportunity of being the maker of your own destiny, right? If you like worked hard and did well, like you'd be incentivized accordingly, and you were incentivized accordingly. And I think that was kind of rare relative to a lot of the other investment banking programs where, I mean, you hear things like, oh, certain groups are a lot more political than others. And the whole like networking aspect wasn't something I was like super, I did very well when I was in college, and something I've had to like learn and get those like interpersonal skills better. So I like the idea at Bear, like it wasn't like a political environment. It was like,
right.
If you did well,
you're a smart person. You can come there and just crush work.
Right.
And just who cares about all the awful politics stuff.
Yeah.
Okay.
So I had the offer letter in March of 2008. And, I remember like the week after that, the Bear stock price was just, one day it was down 5%, next day it was down 10, 15%. By that Sunday, like JP Morgan had made an offer for Bear. And initially the offer was like $2 a share. And I think it was ultimately bought for $10 a share. And pretty much every group was cut at Bear except the FAS for interns. Because JP Morgan had their own interns, and it's a big bulge bracket, so they have a large internship class. So fortunately, and I was like 95% convinced, my internship was gone, and I'd have to go back to Ohio and find something else to do that summer, which is going to be a huge bummer. Fortunately, they kept the FAST program.
Somehow Bear said, these are our best interns. You should keep this. So for that first year, or for those first months, JP Morgan kept the FAST group.
Okay. So I was an intern within the FAST group.
I see. They kept the
and the logic, I think, from JP's point of view was like, look, this program makes sense. I mean, it was a great way to see like the different roles within MBS trading, like within the MBS product group, right? So like structuring, sales, and trading. And FAST was essentially like the center of that like 3-pronged circle.
Got it.
And people from FAST after the first year went to one of those 3 prongs. That was my sophomore year. So yeah, I was fortunate to have the sophomore year. So my junior year, I had an offer in this group called Pricing Direct, which is pricing like just typical structured products, so from credit card loan ABSs to just mortgage-backed securities.
Right.
I saw pretty quick. I mean, there's a kind of a learning curve for looking at structured products, but at the end of the day, once you get over the kind of this learning curve, you're doing the same thing over and over again. And so when I went back to campus, right, I had friends that had internships in more typical like investment banking groups like M&A or certain industry groups like retail or TMT, and their breadth of experience was a lot greater than mine, right? And I think that's generally the case for any sales and trading versus investment banking, where in sales and trading you're looking at just one product, whether it's interest rate derivatives or CDS on a particular industry, or like FX, right? So I felt like I didn't really have the kind of I felt like it wasn't really intellectually like broad. Like there's not like a lot of challenge after you get over that learning curve, because you're literally doing the same thing over and over again.
Right. You can make a lot of money, but
yeah, you can make. I mean, right. And I think that's. I have friends that are in sales and trading and they've done well, but like their big frustration is like you get bored because you're doing kind of the same thing over and over again.
Right. No job's perfect. Right. Okay.
Whereas on the investment banking side, I mean, you're looking at you could argue like on a big picture level, you're doing the same thing over and over again, but you're looking at different situations, and like each situation is idiosyncratic in and of themselves. Like no business is the same. No opportunity is the same. So
that's what you wanted to do. You said, I want to go do.
Right. And I was more kind of focused on the private equity side than on the.
Right. And so the path to private equity is get a regular investment banking job.
Right. So after college, I had an opportunity at a company called Terrigen Power, which is a renewable focused IPP, independent power producer. So Terrigen was backed by two large U.S. infrastructure private equity firms, ArcLight Capital and Global Infrastructure, GIP Global Infrastructure.
Not partners?
Partners, yeah. So these are super, smart like PE firms, and I had the opportunity to be like the first analyst on the finance team at Terrigen. So the role on this team was essentially doing like kind of infrastructure private equity. It was to build out the portfolio at Terrigen. So there's a few development projects we were building out. We built out the largest wind farm in California. I think the largest wind farm in the U.S. at the time. So it's a 1.2 gigawatt facility in Tehachapi, California. And at the time, given my background was more on the sales and trading side, this was like trial by fire finance for me. So going through like financial models, this was more like kind of project finance and kind of like different stage private equity. But again, I studied math and econ at Cornell, didn't take a lot of like finance or accounting courses, so everything I was learning was kind of on the job, completely new. And it was, looking back at it, it was probably one of the most rewarding experiences professionally. And so I did this for about a year and a half at Terrigen.
Where was this?
This was in New York.
New York.
I did this for about a year and a half at Terrigen. And I left to go to to join the master's program at LLC. So they had a program it was a master's in finance and private equity. So what was unique about this was there weren't a lot of master's programs that had a private equity like core curriculum aspect.
Right. I've never even heard of that.
Yeah. So this was taught by a guy named Felda Hardiman, who teaches the private equity course at HBS, and he's also a partner emeritus at Bessemer Venture Partners. He's on like the Forbes Midas 30 of VCs. And so what was really awesome about this was it was taught in the kind of HBS case system. So you're doing a case, through the week. Mm-hmm. And on Friday, Felda, through his like amazing Rolodex of contacts, would actually bring in the principals that worked on these transactions. So, for me, having studied economics and math, which had a very theoretical bent, because I took a lot of even on the math side, right? Like, and on the econ side, I took courses that would overlap for both majors. So if you're looking at like mathematical economics, it's essentially a lot of theory-based courses, like that's econometrics and things. Oh, econometrics isn't very.
Right. I don't really care what the course is. I got it. Math was
so it was unique in terms of like having an academic experience that was super applicable to what I wanted to do.
Yeah, exactly.
So that's really the reason why I left Terrigen. I'd never been to Europe or London.
How'd you hear about this program?
Let's see.
You're typing private equity masters into Google?
So I think a lot of it was the encouragement of my parents that they wanted me to kind of get another degree. Mm-hmm. And so at the time, like an MBA, usually requires work experience.
Right. You were pretty
young. I had an offer from LSE after college without any work experience.
Oh, really?
And LSE actually didn't let me defer the offer, so I had to apply again. Unfortunately, I was accepted the second time as
Lucky
well.
You.
So the two aspects that were unique. Was one, it was a course that was focused on private equity, and that's kind of what I thought I wanted to do. And two, it was just a year long.
It was a year long, and it was one course.
Yeah. Oh, well, it wasn't just one course, but it was it's a year long program. You're taking like 7 different courses, but kind of your main course is this private equity course, and you do your thesis on that course.
Got it.
So I did my thesis. Like my thesis paper was like buying a wind farm in America, basically. So after graduating from LSC, I had an offer at Houlihan in the financial restructuring group.
Wait, so did people go from that program into investment banking, or do some of them get private equity jobs?
Yeah. So we had about a third, or a little bit more than a third, that actually went into consulting.
Okay, yeah, that's
which is what you were saying. I mean,
yeah.
About your MBA class.
That's how business school works. Consulting's the main path.
With a few people going into investment banking, I don't think too many people got placed into PE directly. Maybe one person or two people.
Right.
Because again, I mean, this program didn't require any work experience.
Yeah, and private equity
generally
requires work
requires.
experience.
Yeah, exactly.
Okay.
Yeah.
Okay, so you had an offer from Houlihan's restructuring group.
No idea what financial restructuring was before I,
right. Nobody
applied
does.
to it. Yeah. So from my internship class back at when I was at Bear, I had a buddy named Jagji Adani who I stayed good friends with, and so after he was a year ahead of me. So after he graduated, he joined the restructuring team in New York with Houlihan, and so through his kind of advice, I mean, he got to work on, I think he was the one analyst that was working on the Lehman transaction. And so he was like, look, if you're interested in credit, and this is a super important time for credit in Europe, and this was 2012 when I graduated, so this is the first time people were starting to talk about Greece, right? You had worries about like periphery countries, falling. You had a huge debt maturity wall that was coming due that would have had to get refinanced or restructured. So just kind of on an opportunity perspective, on like a macro level, he said it would be super interesting. And this was, again, right after the financial crisis, so there's not a lot of investment banking deals going on. So I also had friends that were in, big bulge brackets that literally had kind of not so great analyst experiences, in that they, were working on just pitch books, and there wasn't a lot of deal activity.
Right.
And I thought, for me at that point in my career, like the most important thing is, being on live transactions and, getting to be involved, or having the opportunity to be involved in real deals instead of just working on pitch books. Mm-hmm. I mean, sure, you like have some learning from putting a pitch book together, but it's not like working on a deal, right? You don't go through the full, like all of the aspects of the transaction, right? So that was the other big kind of consideration. So we met like kind of that summer after,
right. So you had an offer to go to Houlihan's London office.
Yeah.
Yep. And then, you talked about in the beginning how you recognized private equity was what you wanted to do. I mean, clearly,
right.
You recognized that early on. You went to a master's program,
right,
tailored around private equity. But talk about why private equity is so appealing. Like, why do so many people want to do it? Why don't people want to do investment banking? Like, outside of like maybe you can make a little bit more money and work a little bit less hours. Yeah. Like, what's more appealing about it?
Yeah, I think, I mean, at least for me, and having had the opportunity to work at Terrigen early on, and not really going through that like in investment banking analyst right after college, like in private equity, you're a principal, so you're putting capital where your mouth is. Like, you're looking at, and again, I guess like every private equity experience is different. Like, there's firms like Bain Capital and Apollo that, and KKR that are very different in terms of how they approach deals, and how the analysts and associates and the teams like kind of, look at transactions. But I guess in private equity, unlike investment banking, there's a lot of, like, I would say, time leakage, if for a euphemism of like not not doing like kind of
in banking there's time leakage.
Yeah, because you're, I mean, a lot of banking is kind of like looking at doing marketing exercises, right? Because you're essentially an advisor, right?
Right,
Whereas on the private equity side, you're a principal. Like your firm is putting the capital.
Right. There's money
to,
at risk. There's always
right,
something to do.
Right.
Okay.
And it's more, and the gravity of the situation is higher because of that.
Sure.
And I'm not saying like in investment banking, it's like it's not serious or anything. It's just
very serious.
I mean, it's serious, and there's a level of stress too that comes with working in investment banking. But it's more like I feel like the stress in banking is more, like internal, like deadline type stress. It's not like
no, it's client service.
Yeah, it's client service.
Exactly. The reputation of the bank, and
Right.
and there's still multi-million-dollar fees at stake.
Right.
Right, but there's not your principal, your investor's money.
Yeah. And I was speaking with a firm called Ice Canyon for like almost 3-4 months.
Mm-hmm.
So the process of like hedge fund recruiting is you have a few rounds of like phone interviews. A lot of the conversations on those calls relate to your experience, like kind of the deals you worked on before.
Right. What was the deal? What'd you do?
Exactly.
What was the outcome?
Right.
Okay.
And so I was, within different hedge funds, you're either interviewing to work with a particular portfolio manager who covers a specific industry, or maybe, you're a generalist somewhere. In this role, I would have been working with the portfolio manager who covers global energy. So having someone that had some energy experience was
right.
super
Your
relevant.
Terragen thing. So
exactly. So they saw my experience at Terragen, and that was really interesting to him, because there were opportunities on the renewable side that were starting to pick up.
Right. So two phone interviews, and then what?
It wasn't just 2 phone. It was a few phone interviews, then a case study. I did my case study on Dynegy.
What they say? Did you pitch us an investment?
Yeah, which the case study is pretty broad. It's like, take a look at this company, tell us where you would invest. So you have the opportunity to invest across the capital structure. You can invest in the company's bonds, the bank debt, the equity. You could,
right. So
you could go long or short. So it's,
that's your work in investment banking.
Right.
But without the kind of recommendation piece.
Right.
So you took that home and you spent a couple days looking at that?
Yeah. And so the challenge for me was, I worked for Terragen, where I looked at renewable, so solar, wind, geothermal companies, and Dynegy, is a merchant IPP, right? So their focus is on coal and natural gas, and I'd never looked at a natural gas generating model or even a coal generating model before. So the challenge was kind of building that by myself, building a financial model for those two technologies by myself. So ultimately I was able to figure it out. I mean,
clearly, because you got the job.
Right. But yeah, so anyways, I mean, that the case study process was probably the longest aspect of that, because I remember submitting my case study and then having follow up, 3 or 4 follow up calls just on the case study, and
them asking you questions about your model.
Yeah,
why?
We went through almost line by line of my model, God. Which maybe, I mean, there's probably some funds that do that. I mean, again, the interview process for, I guess, hedge funds is very idiosyncratic. There's not a typical process.
I mean, they're going to be paying you a lot of money. They want to make sure you're the right guy.
Yeah. Yeah. So again, I was in New York. This fund was in LA.
Right. It's part of Canyon Capital, right?
It's a joint venture with Canyon.
With Canyon Capital, the big real estate. Private equity fund. Okay.
Hedge fund.
Yeah.
I'd never been to LA before. These were calls at 6-7 p.m. New York time, to facilitate the time these guys were free in LA.
Right.
And then Skype calls and things like that. And I flew out here for my final round interview. And I remember when I got here, one of the guys on the team had a convertible, and he was driving around the city, and I was like, man, this is amazing. and this was, I moved back to New York right when there was like the polar vortex. So it's like crazy cold.
Right.
And so going to LA like after that, that probably like helped seal the deal in terms of
I think they knew that
back in,
picking up from the airport in the convertible.
And so I remember like having lunch on like a Sunday with the PM in Manhattan Beach. Here I'm like, man, like looking at the ocean. It's like 75 degrees, sunny. So that definitely like kind of helped convince me that this is
right. And this is when you and I reconnected. We hadn't talked in a while, and you called me up and said, "Hey, I might be moving to LA."
Right.
And I was like, "Oh shit, that'd be cool.
Yeah.
Take the job."
So I moved to LA in the beginning of August. And so I started at
2014.
2014, beginning of August 2014. And so I just started at ICE like pretty like within a week of moving here. So got acclimated. Like I hadn't driven a car in 8 years.
Yeah,
at that time.
I remember you banged up your rental car pretty good.
Yeah. So it definitely had some like kind of growing pains or whatever, getting into LA.
Right.
But yeah, I mean, having been here, I really fell in love with the city.
Yeah, it's tough not to.
Yeah.
And how long did you work for ICE for?
About 2 years.
2 years. And what happened?
So at the time I joined, well, actually, I'm not sure I can.
You don't want to say this, so don't.
I've looked at like a non-disparagement clause with.
Let's not talk about that then. So just say now you work at a hedge fund in Hong Kong.
Yeah, well, I mean,
just say don't say anything if you don't want to.
Yeah, it's probably better not to talk about returns and shit. Like,
yeah, just say you've got an opportunity.
Yeah, so I ended up having an opportunity in Hong Kong after 2 years. And I'd never been to Hong Kong before. I didn't want to leave LA, but the opportunity was pretty interesting in the sense that I'd have a little bit more autonomy, and the structure was set up whereby it was again more of a kind of eat what you kill model in the sense that you have a P&L and you're getting points on that P&L.
Right, you're going to be making your own investment decisions as opposed to just like supporting.
Yeah, I'm still going through an investment committee.
Obviously, that's how funds work. But like in LA, you supported a guy. He would say, "Take a look at this." You take a look at it. In Hong Kong now, at this new job, like, you're the guy.
Right.
Okay.
Right. So I have more autonomy to like kind of try to find opportunities.
Right. And this opportunity was like just as fast. You called me and you said, "I'm moving to LA," and you called me and said, "Hey, I'm moving to Hong Kong."
Yeah.
I was like, oh, okay. And like you moved there and like you started working like the next day. It was like a super
I started working like a week.
It's like you've had a pretty successful little career here. How do you do it? Like, what do you attribute it to? What can other people try to learn from you?
Well, I don't think I've had a super successful career.
So you make a lot of money, right?
Yeah, but I mean,
you got to live in some cool places and you make a lot of money, and I think a lot of people would be
sure. Yeah, I think having the drive to like kind of want to do better is important.
Mm-hmm.
I think being open, like again, I don't know if this is a good thing, but I don't have a lot of ties to, when I left London, like I never really had a relationship in
well, you had
London,
time. I mean, you had a girlfriend here and stuff, but like you're open to moving to an entirely new place you've never been to and starting work the next day.
Right.
Okay, I'll buy that.
Yeah, and maybe it's because I was born in a different country and like I'm not super afraid about like meeting new people and getting accustomed to or adapting to a different like world.
Right. You said at the beginning of the call you were just kind of more of a book smart person, but from what I know about you, you're a pretty outgoing person. You like to go up to strangers at bars and strange women at bars.
I feel like I'm outgoing when I want to be. I don't think that's like my default personality.
Right.
I think my default personality is more introverted.
So that that's like you do it because it's not your personality. So like you go over the top to like compensate.
Maybe. I don't know if I would say I go over the top, but
well, over the top for who you are.
Yeah, for who I am, but
yeah.
Yeah, sure. Um, yeah, I think if I were to think, for the next 5 years of my life, I want to be in a place where I can have more responsibility and autonomy going forward. And I feel like, continue to kind of constantly learn, right? Like the stuff I'm doing right now. I mean, one aspect that's interesting is just recently, right? Like at year end, India incorporated a new bankruptcy code, which is going to make the opportunity for investing in distressed investments in India a lot more compelling for a few reasons. One, this bankruptcy code says that anyone that has claims of at least $1,500, right, can go to the NCLT. NCLT stands for like National Criminal Law Tribunal or something like that in India. So the NCLT will then appoint a independent resolution professional, and that IRP has 180 days to resolve a restructuring. If that doesn't happen, the company gets liquidated, right?
Wow.
So yeah, this sounds aggressive, and it's meant to be, because historically what's happened is, a lot of Indian companies will just willfully default and drag on, a restructuring process for years. So imagine if you lent someone money and they just basically, tell you they're not going to be able to pay you, and that claim, nothing happens to that claim for the next 3 years. That's a terrible return on investment. Your money gets locked up, and it's one reason why there haven't been a lot of institutional investors looking at opportunities in India, at least on the distressed side, right? So with this new bankruptcy code in place, it's meant to kind of, make the opportunity for investing in distressed securities a lot more interesting, or a lot easier for kind of foreign investors like hedge funds, because, as a distressed investor, right, the company, I mean, you have leverage on these companies now, right? Because, you file a claim with the NCLT. I mean, they have 180 days to resolve the restructuring.
Right.
If they can't do that, the promoters, I mean, whose wealth is tied up in this firm, I mean, he's going to be at a huge loss if the firm gets liquidated. So, I mean, there's going to be a huge market for Indian distressed opportunities going forward. And so I think I'm moving to Hong Kong. I wouldn't have known about this if I didn't take this job in Hong Kong, right? And it's kind of expanded my view on kind of other opportunities in Asia. And what we were talking about earlier, which is, I think when situations are a little bit more obscure or niche, just in general, when there's like higher barriers to entry, the potential return profile on an investment is also higher, to kind of compensate for those things. And that's certainly the case for, like, if you look at the bank loan market in India, right? I mean, that's definitely the case. And I'd say distressed investing in Asia is a little bit more different than looking at a distressed opportunity in like the US for a Chapter 11 process, because a lot of these transactions are negotiated transactions with the promoter, right? So whereas in the US,
The owner of the business.
the promoter. In Asia, I mean, the promoter is the term that's like the owner, the entrepreneur, or the founder. So there's definitely aspects of like investing in like an Indonesian company or an Indian company where there's third world aspects, like quote unquote like leakage, right? Like where you might have a not so virtuous promoter that takes capital from his firm, and this is probably like standard practice in a lot of EM countries. And so if you're a distressed investor, I mean, how do you protect against that? It's really hard to. I mean, the best solution is just, this is generally like a risk that's priced into the security. getting a higher yield investing in like a Indonesian coal company than you would be investing in like Peabody Energy, right? Which is it's like the biggest U.S. coal company here.
Yeah. So it sounds like you're seeing some cool stuff, eye-opening things. So I wish you luck. Lots of good luck in distress investing. And thanks for being on the podcast with me.
Yeah, you're welcome.
And thank you for listening. Check us out on iTunes or at wallstreetoasis.com. And stay with us. There's lots more coming.